Why the war on Ukraine is a turning point for markets too. The shock to Europe's economy will overturn the debate on monetary policy. Robin Brooks, Financial Times. While Russia's invasion on Ukraine has undoubtedly opened the political scene in Europe, it also marks a watershed for financial markets. The writer is chief economist at the Institute of International Finance. Russia's invasion of Ukraine is a turning point for Europe's politics, as has been widely recognized in the short space of a few days. What is less widely recognized is that we're also a turning point for markets. Europe is in the early stages of a big adverse shock to its economy, which will open the debate over monetary policy. Think back to just a week ago, when there was still collective hands writing about elevated inflation. That is now old news. The interesting thing and the opportunity is that markets have not yet recognized or priced this. Take the case of elevated inflation. In a recent analysis by the Institute of International Finance, we warned about the breadth of the inflation rise in Europe, which was being led by genuine overheating in Germany. But Germany is now also on the front line in confronting Russia and one of the most exposed economy to what certainly will be deep recession to the east, and that changes the inflation debate. Central banks worry about supply stocks because of second round effects, which is when a strong economy emboldens producers to pass on higher energy and other costs to consumers. That happens when there is strong demand, which is what gives company pricing power. None of this applies anymore. Uncertainty has risen massively, which will pull down consumers' confidence. And that uncertainty does not just relate to obvious geopolitical risks. It goes much deeper. Countries like Germany and Italy build large parts of their economies around cheap energy from Russia. That just now changed, which implies lower growth, wider fiscal deficits, and more debts. The debt nexus for Europe is a tricky one. There have been many voices in recent days criticizing Germany for its low levels of government debt, with many trending Russia's invasion of Ukraine as a kind of told you so moment, but that's misguided. If the last couple of years have taught us anything, it is that big negative stocks can come out of nowhere. Recently COVID-19, then COVID-19 variants, and now Russia's invasion on Ukraine. If this isn't an endorsement of keeping powder dry for emergencies, then what is? In the eurozone, this argument has a special urgency because markets were already reluctant to buy COVID debts in issuance in the run-up to all this. For a key periphery country like Italy, new debts issuance was largely funded indirectly via the European Central Bank's quantitative easing program of assets buying to support markets. With this latest stock markets' existing reluctance to fund highly indebted sovereignty will, with bigger fiscal spendings need on the horizon, only grow more acute. If we're right, the fact that inflation is no longer a concern makes things easy. Now is the wrong time for the ECB to worry about normalizing policy. Relative price shifts in the eurozone inflation basket are unlikely to broaden out into generalized inflation, which means the cost is clear for ongoing loose monetary policy and critically QE that from a fiscal perspective is badly needed. There will therefore be a fundamental decoupling in monetary policy, with the US Federal Reserve pursuing normalization while the ECB, given the much bigger stock than Russia worries to Europe, keeps easing. Markets are nowhere near recognizing or pricing this. They are pricing the prospects of monetary policy normalization and rate increases in the eurozone on a par with the US. Speculative positioning in the foreign exchange markets was starting to build a meaningfully long position on the euro versus dollar into last week. In short, the coupling of the eurozone from the US in terms of growth and policy isn't yet remotely built into markets. We've seen all this before. Think back to 2014, which was also a watershed from markets. Russia annexed Crimea early in the year, and then the bottom fell out of oil prices. A US shale took the world by storm. Amid all this, markets were slow to price in the massive policy shift that was unfolding at the ECB, which will ultimately lead to QE in 2015. This is because there were genuine mixed signals. Markets through QE will never be possible given the traditional importance of inflation hawks in the eurozone. Is the same now. Elevated inflation is the mixed signal that's holding back markets now. But that is all news, which reflects the world as we knew it a week ago. Big divergences and the euro weakness against the dollar is coming.